Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing NVIDIA stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. NVIDIA designed graphics processing units, GPUs, for the gaming and professional markets. They also designed chip units for the mobile computing, data center, and automotive markets. NVIDIA, AMD, and Qualcomm are examples of fabless companies. That means they outsource chip manufacturing. Taiwan Semiconductor is the largest foundry in the world. Foundry means it manufactures chips for other companies like this one. NVIDIA is headquartered in Santa Clara, California, and was founded in 1993. The ticker trades on the Nasdaq, Deutsche Börse, Mexican Bolsa, Xetra, Vienna, EuroTLX, Swiss, Sao Paulo, Buenos Aires, Bulgaria, Ukraine, Kazakhstan, and Lima Stock Exchange. Let's get started with the model. This is a large cap company, 665 billion market cap. They're trading at $267 a share, and they have 2.5 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow grows a lot, from $3 billion way up to over $8 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that goes from $4 billion up to nearly $10 billion. Revenue is the sales for the company, and that more than doubles from $12 billion up to $27 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are all the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that grew a ton from $10 billion up to $17 billion. Below that is their operating expenses. R&D is their biggest operating expense by far. Gross profit minus operating expenses gives you your operating income. And that also grew a ton from $4.5 billion to $10 billion. They spent $236 million of interest on their debt, which is a lot more than prior years. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. An example is the gain on the sale of an investment. Then you have your pre-tax income, your taxes, and the bottom line of the income statement is your net income. They don't pay much in taxes. That's pretty interesting. Maybe they're using a lot of tax credits from prior years. This is their income statement from their 10K, and their revenue in 2022 was $27 billion. Here's a breakdown of their revenue by country. Their most is in Taiwan at $8.5 billion, China is $7 billion, US is $4.3 billion, and all other countries are $7 billion. The gaming market is still their biggest market at $12.5 billion, data centers $10.6 billion, professional visuals is $2.1 billion, automotive is $566 million, original equipment manufacturers and other is $1.2 billion. Their cost of revenue is $9.4 billion, so their gross profit is $17.5 billion. Their gross margins are 65%, that's gross profit over revenue. The average in the industry is 46%. That's why their stock price is so high, because they have great margins. And look at their net profit margins, 36%. That's net profit over revenue. The median in their industry is 11%. They spent over $5 billion in R&D in 2022, $2 billion in SG&A, so their operating income was more than double 2021. Same thing with their net income, it was more than double 2021. It's better to look at earnings per share, because if a company's adding lots of shares, their EPS may go down while their net income goes up. But not with this company. Their EPS goes up every year from $1.15 to $1.76 to $3.91. Their shares outstanding are pretty much flat every year, 2.4 to 2.5 billion. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. And that was the most in 2022, over $9 billion. They spend close to $1 billion in CapEx in 2022. Operating cash flow minus CapEx gives you your free cash flow. And they pay a really small dividend, so most of their free cash flow goes back into the company. And they don't really add or buy back stock. Except in 2019, they bought back $1.6 billion of stock. This is a breakdown of their operating cash flows. And the way you calculate operating cash flow, you start with your net income, that was $9.8 billion. Then you add or subtract the non-cash items on the income statement. We add back $2 billion of stock-based compensation, $1.2 billion in depreciation and amortization. We minus out $400 million of deferred income taxes. We talked a lot about this on a live stream yesterday. And we have to adjust for changes in working capital. It looks like they extended $2.2 billion of credit, so that's a cash outflow. And they bought $774 million of inventory, that's also a cash outflow. So their cash flow is a little less than their accounting profit. In 2020 and 2021, their cash flow was higher than their accounting profit. The big difference in 2022 was the accounts receivables and the prepaid expenses. I like to track a company's revenue, that's the blue line, and operating cash flow, that's the orange line. And look how much their revenue has gone up the past 2 years. And their operating cash flow is also at its all-time high. Their revenue is projected to continue growing a lot, up to $46.6 billion in 2025. Their operating cash flow is also projected to grow a lot and flatten out in 2024. This is their investing and financing sections from their statement of cash flows. In their investing section, they purchased $25 billion of marketable securities. These are usually short-term liquid investments, and $15 billion of those securities matured. They only spent $1 billion in PP&E. They didn't spend much in acquisitions. Last year they spent a lot in acquisitions, $8.5 billion. Most of that $8.5 billion was from Mellanox, $7.1 billion. Mellanox is a supplier of computing, storage, and communications applications. They mainly acquired this company to optimize their data center products. So in their investing section, they had a cash outflow of $10 billion. Last year was a cash outflow of $20 billion. In their financing section, they added $5 billion of debt, and they paid down $1 billion of debt. When they give employees stock, they have to pay taxes on that stock. They paid $1.9 billion of taxes. In their financing section, they had a cash outflow of $2 billion. Last year was a cash outflow of $4 billion. This is the equity section on their 12/31 balance sheet. They have $27 billion of equity. They raised $10 billion from selling their business, and they profited $16 billion from running their business. Let's look at the capital structure. $27 billion of equity, $12 billion of debt. They're 69% equity, 31% debt. But they could pay off all the debt with the cash on their balance sheet and still have $9.5 billion of cash left over. The blue line is their equity balance. Look how much it's gone up since 2015. Their cash balance is also really high, well above their debt balance, which is the red line. I gave them the whack on Simply Wall Street, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's $415 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $342 billion. We divide that by 2.5 billion shares. And we get a calculated stock price of $137. They're trading at $267, so they're trading at a 94% premium. It's a sell according to the model. The forecast is for their revenue to hit $46.6 billion by 2025. So I grew their revenue proportionately from 2022 to 2025, so it hits that $46.6 billion. That's an annual growth of 21%, and I grew it again 21% into 2026. So that's how I got their future revenue estimates. They convert 31% of their revenue into free cash flow, so I multiplied their future revenue estimates by 31%. That's how I got their future free cash flows. But I'm still coming out with a stock price a lot lower than they're trading at. It's kind of like Tesla. The stock price keeps going up, even though it's overvalued. The website Simply Wall Street values them at 182. They're also saying it's overvalued by 47%. 27 analysts priced this stock, and the average price target is 353, the lowest 245, the highest 410. This is where the stock has been trading the last 5 years, and it's gone up a ton since the beginning of 2020. It was well over $300 at one point. It did come down to about $225, but then there's been a big surge the past few weeks, and it's up to $267. If you bought the S&P 500 5 years ago, you'd be up about 100%, but this stock you're up about 900%. At one point you would have been up 1200%. They have a beta of 1.41, so the stock is a little more volatile than the market. It's up 91% in the past 52 weeks, while the S&P is up 11%. The 52-week low is 134, the high is 347. And the stock is trading above its 50-day and 200-day moving average. This is a really popular stock. Over 50 million shares are traded each day. Of the 2.5 billion shares outstanding, 2.4 billion are on float. 2/3 are held by institutions and only 1% of the shares are shorted. They pay a dividend of 4 cents per share, which is only 6 basis points, 5% of their free cash flow. Their dividend yield was much higher in 2013, about 2.5%. But they have not raised their dividend, but their stock price has come up so much, it makes their yield look so low. They've done 5 stock splits, a 2-for-1 in 2000, 2001, and 2006. A 3-for-2 in 2007, and a 4-for-1 a few months ago. They've added a lot of employees since 2020. They're up to 22,500. If you put $10,000 into this company 10 years ago, you'd have almost $800,000 today. That's an 8,000% return, a 55% annual return. In the past 12 months, there's been no insider buying, just selling. Every quarter, there's multiple people who sell. These are all the people that sold in the past 12 months, the shares and the price they sold at. 66% of the company is held by institutions, 31% by the general public, and 4% by individual insiders. The biggest shareholder is Vanguard at 8%, then BlackRock, Fidelity, State Street, and the CEO at 3.4%. Let's look at their financial ratios. They have a high PE of 68, that's stock price over earnings per share. Also a high price to sales of 25 and a high price to book of 25. Their price to free cash flow doesn't look so great either. The reason these ratios don't look good is because their market cap is so high, it's so inflated. Let's look at their non-current assets. 2.8 billion of property and equipment, 800 million of operating leases, 4.3 billion of goodwill. Goodwill is the premium you pay when you acquire another company. 2.3 billion of other intangibles. That 2.3 is broken down to 2.1 billion of acquisition related intangibles and 225 million of patents and licensed technology. They have 1.2 billion of deferred income taxes. This should help decrease the company's taxes in the future, and 3.8 billion of other. Let's look at their non-current liabilities. 11 billion of debt. They owe 700 million on their lease liabilities and 1.5 billion of other. They have a really high return on invested capital of 47%. They can cover their interest payments 43 times with their operating income. A really good ROE of 37%, much higher than a market median of 7%. And they could easily cover their current liabilities with their current assets almost 7 times. And their quick ratio is 6.0. Let's look at their current assets. 2 billion of cash, 19 billion of marketable securities. That 19 billion includes 9 billion of corporate debt, 7% of US Treasury securities, 1.4 billion of government debt, and 1.5 billion of CDs. All of these are highly liquid and low risk investments. They have 4.7 billion of receivables. This is how much money others owe them. 2.6 billion of inventory and 400 million of prepaid expenses. A prepaid expense is when a customer makes an advance payment for a product or service they're going to receive in the future. Let's look at their current liabilities. 1.8 billion of accounts payable. This is how much money they owe others. And 2.6 billion of accrued liabilities. These are expenses the company has incurred, but it hasn't paid it yet. In 2022, they generated over 8 billion of free cash flow. They have over 24 billion of working capital, and they paid out 400 million of dividend payments. So the company's really well funded. They have over 30 billion of funding. The best way to look at ratios to compare them to companies in the same industry. There are 66 companies in the same industry as NVIDIA. And if NVIDIA has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They do have a better debt to equity ratio than average. They don't spend that much in CapEx since they outsource most of their manufacturing to companies like Taiwan Semiconductor or maybe even Intel. Intel designs chips and manufactures them. They pay a really small dividend. They generate lots of free cash flow. They're the largest company on this list in terms of market cap. And they don't have good price multiples because they're such a big company. The higher the market cap, the worse these ratios are. They generate lots of revenue, 27 billion. Intel generates the most. And the reason people buy the stock so much is because they're growing a lot. Their 3-year annual growth rate is 32%, which is better than almost everybody else on this list. ROA is net income over assets. That's really high at 25%. ROE is net income over equity. That's also really high at 37%. So to summarize, I have them trading at a 94% premium. But if you plan to hold this stock for a long time, many years, I think it's fine. In the short term, it may go down, but it just seems like it keeps going up. Some companies just defy fundamental investing. I rank their free cash flows and revenue 10 out of 10, their ratios 2 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.